I need to tell you about something that happened in the first week of March 2026 that almost nobody in the Western financial press connected properly. China dumped $53.3 billion in U.S. Treasury holdings in a single month. Not gradually, not as part of a long-term diversification strategy, $53.3 billion in 31 days. And at the exact same moment, Chinese state institutions added 1.2 million ounces of gold to their official reserves, their largest single-month accumulation since the People's Bank of China began transparent reporting in 2019. Let me put those two numbers next to each other. China sold $53.3 billion in dollar-denominated debt. China bought $6.1 billion in gold at current prices. Same month, same government. And gold, which had been trading between $3,200 and $3,400 for most of February, spiked to $3,789 on March 9th, the day after Bloomberg reported the Treasury holdings data. Most investors saw that headline and moved on. I have been watching reserve currency transitions for 40 years, and what I saw in that data was not a headline. It was a trigger. The kind of trigger that doesn't announce the collapse. It announces that the collapse has already begun, and most people are reading the wrong indicators. By the end of this, you will understand exactly what China did, why it is structurally different from every previous round of Treasury sales, what the three-layer mechanism is that turns a bilateral financial decision into a global monetary crisis, and why the gold price on March 9th was not reacting to fear. It was pricing the mathematics of a reserve currency system that just lost its largest creditor's confidence in a way that cannot be reversed. Subscribe now. Here is exactly what happened and why the mechanism underneath it changes everything. Let me start with the number that matters, not the $53.3 billion. The number that matters is 18.4%. That is the percentage of U.S. Treasury debt held by foreign governments that China represented as recently as 2013. As of March 2026, that number is 7.8%. China has reduced its Treasury holdings by more than half in 13 years, and the final $53.3 billion that moved in March represents the acceleration into the final phase. Here is the mechanism step by step. Step 1. China sells $53.3 billion in U.S. Treasuries. Those bonds are sold to another foreign government, a domestic U.S. institution, or the Federal Reserve itself through operations that functionally achieve Treasury monetization. Step 2. When foreign demand declines and the Federal Reserve must absorb more issuance to keep yields from spiking, the monetary base expands. That expansion is inflationary, particularly when it coincides with $9.2 trillion in annual debt refinancing at rates between 4.25% and 4.75%. Step 3. China takes the dollars from selling treasuries and converts a portion into gold through direct purchases from London bullion market vaults, Swiss refiners, and bilateral agreements with gold-producing nations. The 1.2 million ounces added in March moved government to government, refiner to central bank, in transactions reported only after the metal was vaulted in Beijing. Step 4. Other central banks watch what China does, not what China says. What China does with its reserve allocation. When the second largest holder of U.S. Treasuries executes a $53.3 billion sale in a single month and simultaneously adds the largest monthly gold position in 5 years, every reserve manager from Warsaw to Jakarta is recalculating the dollar weighting in their portfolios. That is the mechanism. It is a mathematical game theory problem in which every central bank knows that if they are the last ones holding dollar reserves when confidence breaks, they absorb the loss. The way you signal you are not going to be the last one holding dollars is you sell treasuries and buy gold, publicly. On the record. China just sent that signal louder than any policy speech. Now let me tell you what makes this structurally different from every other time China has sold treasuries. Here's where things get important. In 2015 and 2016, China sold approximately $200 billion in treasury holdings. The reason was currency defense. The yuan was weakening. Capital was fleeing. The People's Bank of China needed dollars to intervene in currency markets. That selling was reactive, defensive, and temporary. March 2026 is different. China's currency is not collapsing. The yuan has been relatively stable against the dollar for 8 months. There is no capital flight crisis. China's foreign exchange reserves stood at $3.2 trillion as of February 2026, effectively unchanged from January. The sale of $53.3 billion in treasuries was not a crisis response. It was a discretionary reallocation, and the reallocation target was gold. Let me walk you through the 3 layers of what this reveals. Layer 1. The dollar's safe haven premium is being questioned by the largest foreign creditor. For 50 years, the assumption underlying the Treasury market has been that in a global crisis, everyone buys dollars and treasuries because there is no alternative with the same liquidity, depth, and legal protections. That assumption created a structural bid for U.S. debt that allowed the United States to borrow at lower rates than any other government on Earth. China selling $53.3 billion in treasuries during a month when oil is above $100 and the Middle East is experiencing its most serious military escalation since 1973 is a direct empirical rejection of that assumption. The crisis happened. China sold dollars. That is the opposite of what the safe haven theory predicts. And the asset China bought instead, gold, is the only monetary asset with no issuer, no counterparty, and no jurisdiction that can freeze it through sanctions. Layer 2. The recycling mechanism that funds U.S. deficits is breaking. The United States ran a fiscal deficit of $1.83 trillion in fiscal year 2025. That deficit must be financed by someone buying the bonds. Historically, foreign central banks, particularly China, Japan, and the Gulf states, absorbed a significant portion of that issuance. China reducing its holdings by $53.3 billion in a single month means the United States must find another buyer for that $53.3 billion, plus the new issuance required to fund the ongoing deficit, plus the $9.2 trillion in maturing debt that must be rolled over this fiscal year. When foreign demand declines and domestic demand is insufficient, the residual buyer is the Federal Reserve. And the Federal Reserve buying treasuries with newly created reserves is monetary expansion. That expansion is inflationary, and inflation erodes the real value of dollar-denominated debt, which is exactly what foreign creditors like China are trying to avoid by selling. Layer 3. The gold accumulation is not diversification, it is preparation. China's official gold reserves now stand at approximately 2,264 tons, up from 1,054 tons in 2015. That is an increase of 1,210 tons in 11 years, but the accumulation has been accelerating. In 2023, China added 225 tons. In 2024, 256 tons. In 2025, 289 tons. And in the first quarter of 2026 alone, China has added 98 tons, which annualizes to 392 tons if the current pace continues. This is not portfolio diversification. This is strategic accumulation ahead of a monetary transition that Chinese policymakers have concluded is inevitable. China has continued buying gold, even as the price has risen from $1,800 in 2023 to $3,789 after the March announcement. Price-insensitive buying at rising prices is the signature of a buyer who is positioning, not trading. Now let me tell you what Ray Dalio sees when he looks at this data, because his framework on reserve currency transitions is the most precise diagnostic tool I have encountered in 40 years of watching these cycles. Ray Dalio has spent his career studying the rise and fall of reserve currencies. The Dutch guilder in the 1600s, the British pound from 1800 to 1950, the US dollar from 1944 to the present. His framework identifies the sequence of events that precedes every reserve currency transition, and that sequence is not a sudden collapse. It is a gradual loss of confidence that accelerates when a triggering event removes the ambiguity. The sequence he watches is this. Phase 1. The reserve currency country accumulates debt faster than its economy grows. The United States has been in this phase since the 1980s. Federal debt as a percentage of GDP has risen from 31% in 1980 to 124% in 2026. That is a 40-year trend, not a crisis event. Phase 2. Foreign creditors begin reducing exposure gradually, testing whether the market can absorb the selling without a crisis. China has been in this phase since 2013, reducing Treasury holdings from 1.3 trillion to 780 billion over 13 years. Gradual, methodical, not disruptive. Phase 3. A geopolitical or economic event forces foreign creditors to choose between continuing to fund the reserve currency country's deficits or protecting their own strategic interests. This is the phase transition moment. March 2026 is that moment. The event was the Iran war, the closure of the Strait of Hormuz, and Iran's demand that oil transiting the strait be settled in yuan, not dollars. That demand placed China in a position where continuing to hold large dollar reserves was incompatible with China's strategic interest in securing energy supplies through the yuan settlement system Iran just operationalized. China chose energy security over financial continuity. And once that choice was made, the $53.3 billion sale was not a policy decision. It was a mathematical consequence. Dalio put it this way in his framework on reserve currency transitions. In every historical case I have studied, the transition from one reserve currency to the next does not happen because the new currency is ready. It happens because the old currency loses the confidence of its largest creditors in a way that cannot be restored through policy adjustments. The British pound did not lose reserve status in a single week in 1967 when it was devalued. It lost reserve status over 27 years, from 1940 to 1967, as Britain's debts from World War II made it clear the pound could not maintain its value and its global role simultaneously. The triggering event in 1967 was not the cause. It was the moment when the accumulated loss of confidence became undeniable. What I am watching in March 2026 is the same pattern. The United States has been accumulating unsustainable debt for 40 years. Foreign creditors have been reducing exposure for 13 years. The Iran war created a forcing function, and China's $53.3 billion Treasury sale, combined with 1.2 million ounces of gold accumulation, is the signal that the largest foreign creditor has concluded the dollar's reserve status is no longer compatible with China's strategic priorities. That conclusion, once reached, does not reverse. Now let me show you what the market data confirms, because the price action in gold, treasuries, and the dollar index in the 2 weeks following China's announcement tells you everything you need to know about whether the market agrees with my assessment. Gold spiked from $3,221 on March 8th to $3,789 on March 9th, a single-day move of $368 per ounce. That is the largest single-day dollar move in gold's history, not the largest percentage move, the largest absolute dollar move. The previous record was $250 during the March 2nd Iran war spike. The 10-year Treasury yield rose from 4.18% on March 8th to 4.37% on March 12th. That is a 19 basis point move in 4 days. When the largest foreign creditor sells $53.3 billion in treasuries, yields rise because bond prices fall. More sellers than buyers means lower prices, and lower bond prices mean higher yields. The U.S. dollar index fell from 99.2 on March 8th to 97.8 on March 14th. A falling dollar index during geopolitical tension is the opposite of what the safe haven theory predicts. The dollar is supposed to strengthen when the world is in crisis. It weakened. Those 3 data points, gold up, yields up, dollar down, are the exact configuration that occurs when the market concludes a reserve currency is losing confidence, not collapsing, losing confidence. The difference between those 2 words is the difference between a crisis and a transition. A crisis is temporary, a transition is structural, and the gold price is not reacting to fear. It is reacting to the mathematics of what happens when the largest foreign creditor decides that holding the reserve currency is no longer strategically viable. Let me tell you what I think the 2 scenarios are from here, because I think the most useful thing I can give you is not a prediction but a map of the possible paths and the signposts that tell you which path we are on. Scenario 1. China's Treasury sale was a one-time strategic message, and the pace of selling returns to the gradual $10 to $15 billion per quarter that characterized 2018 and 2019. In this scenario, the March sale was a signal, not the beginning of a liquidation. China wanted to demonstrate it has alternatives to the dollar and that it will use those alternatives if U.S. policy threatens Chinese strategic interests. The message having been sent, China returns to a managed reduction that does not disrupt markets. Gold consolidates in the $3,600 to $3,900 range. Treasury yields stabilize, and the dollar index recovers. The transition continues gradually, over years, not months. The investors who accumulate gold at $3,600 during the consolidation will benefit, but the move is not explosive. I assign this scenario a 35% probability. Scenario 2. China's Treasury sale was the beginning of an accelerated liquidation, and the $53.3 billion in March is followed by $40 to $50 billion per month for the remainder of 2026. In this scenario, China has concluded the dollar's reserve status is eroding faster than previously assessed, and that holding $780 billion in treasuries exposes China to unacceptable risk of capital loss through inflation or through sanctions freezing the assets entirely, as happened to Russia's $300 billion in reserves in 2022. The mechanics of this scenario are straightforward. If China sells $40 to $50 billion per month for 12 months, that is $480 to $600 billion in annual selling. The Treasury market must absorb that selling. If foreign and domestic buyers cannot, the Federal Reserve must. And the Federal Reserve absorbing $480 to $600 billion in treasuries in a single year is quantitative easing by another name, regardless of what the Fed calls it. QE is inflationary. Inflation drives real yields negative. Negative real yields are the most powerful fundamental driver of gold prices in the modern monetary system. In this scenario, gold moves to $4,500 to $5,200 by end of 2026, not because of fear, but because the mathematics of the reserve currency transition forces central banks globally to increase their gold allocations as the dollar's share of reserves declines. I assign this scenario a 45% probability. The remaining 20% is distributed across tail scenarios. A U.S.-China diplomatic breakthrough that restores Treasury demand. A deflationary collapse that drives flight to safety into Treasuries despite China's selling. Neither is impossible. Both are unlikely given the current configuration. Here is what I watch to determine which scenario we are in. Not gold's price. Not the headlines. Two numbers. Number 1. China's Treasury holdings in the April data release, published in mid-May. If China's holdings decline another $40 to $50 billion in April, scenario 2 is confirmed. If holdings are flat or decline less than $20 billion, scenario 1 is more likely. Number 2. The Federal Reserve's balance sheet in the weekly H41 release. If the Fed's Treasury holdings increase by more than $30 billion per month consistently, it means the Fed is absorbing the foreign selling that the market cannot absorb. That is the mechanism by which Scenario 2 produces inflation and gold repricing. I have been managing capital across geopolitical and monetary transitions for 40 years. I have watched the Plaza Accord in 1985, the Asian financial crisis in 1997, the Euro crisis in 2011, the Russian reserve freeze in 2022. Every one of those events was a stress test of the dollar's reserve status. Every one, the dollar survived because there was no credible alternative and because the largest creditors continued buying treasuries. March 2026 is different because China did not buy. China sold. And China bought gold. At the same time, in the largest monthly totals for both transactions in years. That is not a stress test. That is a verdict. One type of investor will read this and conclude that because the dollar has not collapsed, the analysis is overblown. They will wait for confirmation. Confirmation in financial markets arrives after the majority of the move is complete. By the time it is obvious to everyone that the reserve currency is transitioning, gold will be at $5,000 or $6,000, and the accumulation window will be closed. The other type of investor understands that reserve currency transitions are not binary events. They are processes, and the process does not announce itself with a press conference or a policy statement. It announces itself with data, with reserve allocation decisions, with central bank gold purchases that continue regardless of price. China sold 53.3 billion in treasuries. China bought 1.2 million ounces of gold. Same month, same government. That is not a headline. That is a mechanism. And the mechanism, once triggered, does not reverse until the transition is complete. This was not a China story. It was not a treasury market story. It was a story about the moment when the largest foreign creditor of the world's reserve currency concludes that the strategic cost of holding that currency exceeds the financial benefit. And about what happens to every dollar-denominated asset, every treasury bond, every retirement account, when that conclusion spreads from Beijing to Tokyo to Riyadh to Warsaw. The paper market will volatility trade this. The structural market is repricing the reserve currency system. And gold is not guessing which scenario plays out. Gold is pricing the fact that both scenarios end the same way, with more central bank gold buying, with less foreign treasury demand, with a dollar whose share of global reserves declines every quarter. In 40 years, I have never seen a reserve currency creditor execute a $53.3 billion sale and a 1.2 million ounce gold purchase in the same month, and have that signal mean nothing. The signal is the mechanism, and the mechanism is the map. Most investors don't know how to read the map. Now you do.